Actually, all age groups were more positive in the month, and the increase in confidence was the sharpest for consumers between the ages of 35 and 54.
You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Erik Lundh, Global Senior Economist at the Conference Board and guest host of today's episode. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index, as well as our outlook for the global economy. Joining me today is Dana Peterson, Chief Economist and Leader of the Economy, Strategy, and Finance Center at the Conference Board. Welcome, Dana.
Hi, Erik. Great to be here.
So, Dana, we got some numbers out this morning, consumer confidence for October. What were the biggest takeaways we got this month?
The biggest takeaway is that consumers were overwhelmingly positive in October, even as the U.S. elections are just a few weeks away. In fact, they're next week. And indeed, when we look at all the indicators or the sub-indicators for the headline, every single one of them was positive, both the present situation and expectations. And most notably, consumers were much more optimistic on the labor market, even though we saw some weakness in those figures, the confidence figures over the last few months.
So you said we saw some improvements in some of the components. What did the index itself do for the month?
Sure. So the overall index popped to 108.7 from 99.2. And also, we had an upward revision to the previous month. So basically, 2 months of pretty solid gains in terms of confidence.
Now, I know that we also track this across sort of different demographic groups. Was there any differentiation by age or income?
Actually, all age groups were more positive in the month, and the increase in confidence was the sharpest for consumers between the ages of 35 and 54. In terms of income, householders who earned 100,000 or more remained the most confident, and also householders who were 35 and under were also the most confident. But overall, we saw gains across most income and age groups.
And in terms of expectations about the future, that's something that we've been watching. It has been a little bit depressed, but we saw improvement there. What drove that improvement?
Yes, a lot of it improved because expectations for employment turned positive. And this is the first time we've seen that measure being positive since July of 2023. So over more than a year, consumers were pretty pessimistic about the labor market going forward. The interesting thing is that over the last year, the labor market has actually been very strong. Consumers have been working, there's been hiring, wages remain elevated. And even though job openings have come off a bit, they're still higher than they were in 2019. Indeed, job openings are fewer because companies have replenished their payrolls, and we're actually what we think is at full employment.
In terms of recessionary fears, that's also something that we've been tracking. What did consumers say about their concerns about a recession?
Sure, we've been asking consumers about whether or not they believe a recession is going to occur over the next year since July of 2022. And this is the lowest reading that we've ever seen in October. So it seems like consumers are not anticipating recession at any point of the next year. Now, we don't know what the bottom is, but certainly this is the lowest we've seen since we've been asking this question.
Well, it's fantastic to hear that. I know that there has been a lot of concern, but it is ebbing, which is fantastic. In terms of the other chief concern that consumers have been focused on, inflation, what are they thinking about the future of inflation?
Sure, the the expectations measure for inflation 1 year out actually ticked upward, but it's still the lowest we've seen in several years. So consumers, even though they're having a little bit of consternation about inflation right now in terms of expectations, they're not complaining as much about it as they were certainly at the peak when we had 9% CPI inflation and 7% PCE deflator inflation. In terms of write-ins, the biggest write-ins or the most write-ins are still about prices, meaning the level, and also inflation, meaning the rate of change. That hasn't gone away. However, we have noticed more write-ins indicating that people are seeing prices and also inflation being a little less intense. And so that's good news. So while we can look at inflation data and see that it's come down, gauges are getting closer and closer to 2%. The important thing is that consumers feel it and sounds like they're starting to feel the benefits of that.
So as they're starting to feel those benefits, are they also starting to change their sort of expectations and beliefs about interest rates and the stock market as well?
Well, with the stock market, the measure has risen, I think, to the highest ever in terms of confidence and expectations about the stock market. And that's actually a good thing. Even though most consumers do not own any stocks, they do look at the stock market as a proxy for the economy as a whole and also for themselves. Well, if the stock market is doing well, that probably means that my company is going to keep me. I'm going to continue to working, I can continue to spend. When it comes to interest rates, consumers are still saying the interest rates are quite elevated, and that's true. The Fed only cut by 50 basis points, and there's still a lot more to go in terms of rate cuts. But consumers are saying that they are seeing a little bit of evidence of positive news from that 50 basis points of interest rate cuts. But I think they still need to see more further cuts before they get really confident that interest rates are actually going to be lower and are going to stay low.
In terms of how people are feeling about their finances, which sort of captures employment and inflation, what are we seeing on that front?
Well, both the finance measures, both the current conditions and expectations were stronger in the month. So that's important because finances are a function of not only the income that's coming in, but also your spending power. Are your incomes being eroded by inflation? It seems like that's less of the case, and they're saying that their finances are good. And certainly that's positive for additional spending ahead.
Okay. So we are on basically the doorstep of major elections in the US. Are we seeing those sort of political dimensions creep into the results of the survey?
Well, we have been tracking write-ins about elections or politics, anything that you might associate with the elections that are going to be happening next week. And it's pretty tepid. It's pretty tame. Some are mentioning the elections, but it's still much lower in terms of instances relative to 2020 and 2016. So it seems like even up until the last, few weeks, consumers are not terribly focused on the election as being something that's going to have material implications for the economy. But in terms of the ranking, elections came in fifth after prices and inflation and labor market. So it's on their minds, but it's just not intense. There's still more focus on their wallets rather than the politics.
One of the other big sort of news stories over the last month or so has been the effects of hurricanes. We've had a couple of them recently, including a pretty strong one in Florida just a month ago or so. Did we see anything about hurricanes in the data or in the write-ins?
In the write-ins, we did have a few mentions about hurricanes, and we compared this year, 2024 to 2027. 2020, I'm sorry, 2017. 2017 was the last time where we had a very intense hurricane season with many storms, lots of destruction. And back then, we saw about 7% of write-ins reflect hurricanes. This year, it was just 1%. So hurricanes weather did pop up, but it was still only about 1% of respondents saying that they thought it was going to have significant implications for the economy. Again, it's about prices.
Okay, so hurricanes is a little bit about what was behind us, and in terms of what's ahead of us, buying plans. The holidays are coming. We have Thanksgiving on the horizon, and then Christmas. What are we seeing in terms of buying plans, especially for durable goods?
Sure. So, when we look at housing, consumers are becoming more upbeat about purchasing a house. And I think that's a reflection of the fact that home prices are not rising as rapidly as they had been. They're still very elevated. But I think the good news is that households are anticipating that interest rates are going to come down, mortgage rates are going to come down. And so they're getting ready. And certainly for some people who are looking to buy a home, a few Fed interest rate cuts are going to be enough for them to jump in there and buy a home. And certainly these expectations are 6 months out. So 6 months from now, we do anticipate that the Fed funds rate is going to be materially lower, and consequently mortgage rates will fall with it. When it comes to cars, people are still very excited about buying a car 6 months from now. And certainly they're looking to buy new cars. And I think that's good news. And I think that's also a function of the fact that there are expectations that interest rates are going to fall. Yes, there's still a little bit of doubt, but for the most part, it seems like those doubts are laid when it comes to buying cars. When it comes to appliances and electronics, it was a little mixed, a little bit not as excited about buying electronics. But the thing is that, people are still really thinking about buying homes and cars. Those are big ticket items. When you buy a home, you have to fill it with appliances and electronics and buy a car and all those kinds of things. So, the car buying and the home buying will be very constructive for consumer spending, 6 months from now. So I'm not terribly worried about the electronics right now.
Okay. What about on the services side? Restaurants and vacations and things like that.
It is still the case that when it comes to services, consumers are still wanting to go on vacation. They still want to, and once they get to vacation, they can't wait to sit at the hotel and hang out by the pool. They're a little less excited about going to amusement parks and engaging in other types of activities, but we did see a little bit of an uptick in those who are saying that, once they get to the hotel, they will venture out. But it's still the case that consumers are very excited about vacations. Apart from that, they are shifting. They continue to shift towards wanting to buy services that they need as opposed to services that are more discretionary. So things like, car insurance or health insurance, those are still really important for them. And I think that reflects the fact that we have been seeing inflation rise for insurance. So it could be the case that they don't want to pay more, spend more of their incomes on services that they need, but they just have to because those prices are rising. And so we're continuing to see a rotation away from a lot of the more discretionary items, except for travel. They still want to go out and travel.
Okay. All right. Um, uh, in terms of consumer confidence, as we're seeing it this month, what does it tell us about household spending looking ahead in terms of our expectations?
Sure. So again, looking at the expectations for buying 6 months from now, and also what consumers are anticipating for the labor market and business conditions, and even interest rates in the stock market, it all suggests that 6 months from now, they're still going to have some desire to spend. Up until now, we've been seeing very strong consumption readings. Even the tracking for the third quarter, we'll get third quarter GDP this week. But it's still the case that consumers are driving the economy. Now we are expecting a little bit of a soft patch in the fourth quarter and the first quarter, which we'll talk about in a second. But for the most part, once we're beyond that soft patch, it looks like consumers are still going to be in action helping to drive the economy.
Well, great. Then that segues into my final question for you, and it has to do with the U.S. economy in general. What are your expectations? What are we going to be looking at towards the end of this year and into 2025?
Sure, absolutely. So let's start with the third quarter. We're looking at growth that was probably around 2.5 percentage points, and that's probably conservative. So I see some forecasts for above 3% in the third quarter. A big part of that is consumer spending. Some of it's going to be government spending. Also, inventories are going to pop because a lot of companies accelerated inventory shipments of goods from abroad ahead of the East Coast and Gulf Coast port strike. The port strike didn't happen, but those inventories still come in. So we're going to see a pop there. We're not expecting much from the housing market. It's going to be a little less weak than it was. And also, we'll continue to see companies spend on intellectual property. For the fourth quarter, we are probably going to see slower growth. Again, that all the inventories are going to be drawn down, or at least a lot of them. So that's going to be a drag. However, some of that could be offset by fewer imports, right? So even if exports don't do well, if you have fewer imports, then that helps the economy. In terms of consumer spending, I mean, consumers could still, spend quite a bit. We just think it's not going to be as outsized as it has been because consumers, even while they have the capacity to spend, they have, collected a lot of debt. I'm a little less concerned about the debt that they've accumulated because they have savings and they are working. But still, in all, some people might cool off. Certainly after the holidays, you spent everything, and then in January, you take a bit of a breather. We also think that there could be some weight on October readings for the economy because of the multiple hurricanes and tornadoes that happened in the southeastern portion of the US. There was a lot of damage. And so that's potentially going to weigh on October. But as these regions, these states rebuild, these communities rebuild, we should see a pickup in spending by households, businesses, and governments to rebuild. And usually after a hurricane, the net effect, the net impact is positive because you have to rebuild everything, but the initial impact can be negative. So we have a couple of things, the hurricanes and the destocking of inventory that could really weigh on growth in the first quarter. But for all of 2024, we're still looking at a growth rate of around 2.6%. Next year, again, the first quarter might be a little bit soft, but then we'll pick up as we go along and probably end the year around 2.3% on a quarter on Q4 and Q4 basis.
Thank you, Dana. That's a very thorough and thoughtful answer. I appreciate it. So do the listeners. We're going to take a short break and be back in a few moments to have a conversation about the global economy.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm Dana Peterson, Chief Economist and Leader of the Economy Strategy and Finance Center at the Conference Board. I am joined here by my colleague, Erik Lundh, who hosted the first half of the program. I'm going to host the second half, and Erik is our global senior economist here at the Conference Board. Erik, here we are again.
Here we are.
Yeah, so I'm going to pepper you with questions about the global economy. I talked a lot about the U.S., but what else is going on in the world? So what's the global economy as we close 2024, and what are we looking at for 2025?
So, broadly speaking, growth is likely to be cooler in 24 and 25 than it was in the years that immediately followed the pandemic, but that's really to be expected because over those recent years, there was a lot of recovery that was taking place. So now that that has largely kind of come through, we're going to be settling into a more sort of stable growth environment, although one that's growing a little bit more slowly, even than in the years that preceded the pandemic. So for last year, the global economy expanded by about 3.3%. This year, we're expecting growth of about 3.1%. And then we're also looking at 3.1% for 2025 as well.
And which economies were going to be driving this roughly 3% growth as we close out this year and also for next year?
So it is a mix, but broadly speaking, you can kind of divide the global economy into two large buckets. One's for mature economies, and one is for emerging economies. So among mature economies, right, which constitute about 45% of the global economy, we expect that they're going to contribute about 25% of global growth over the next year or so. Among these, the U.S. is going to be the dominant player. Out of the 3.1% growth that we have forecast for next year, the U.S. should account for about half a percentage point of that. Now, on the flip side, in emerging economies, they constitute about 55% of the global economy, so a little bit more than mature. They should contribute the vast majority of the global growth, about 75%. And there's really kind of two key players in that bucket that are going to be driving growth, China and India. For India in 2025, we're looking for about maybe half a percentage point in contribution towards that 3.1%. But China's economy, even though we're expecting it to slow a bit, is probably going to account for about a full percentage point of that 3.1. So really, China, India, and the US are really going to be the key players next year.
Well, for someone who's just looking at this, they're saying, well, why are we going to see faster growth in these emerging markets relative to wealthy advanced economies. What's going on here? Why is this the case?
Well, that's a pretty standard occurrence. Emerging market economies usually grow more quickly than in advanced economies for a couple of reasons. Number one, they're growing from a lower economic base, so there's more room for rapid growth. Another factor is that there's a lot of catch-up potential as these economies adopt existing technologies, as they improve fairly poor infrastructure. It really helps, especially in terms of increasing productivity growth, which helps the economy grow faster. And then there's a variety of other factors as well. There's younger demographics typically in emerging markets, more rapid urbanization, rising middle class, and oftentimes more increased integration into the global economy. So there's a lot more sort of tailwind for these economies than for advanced economies.
Thanks, Eric. So, our China economists downgraded the forecast for Chinese real GDP growth. Why did they do that, and what should we expect ahead?
Sure. So yes, we did downgrade our 2024 outlook for China to 4.8% from 5%, which had been our expectation. At the beginning of the year, China's economy actually launched into 2024 fairly above expectation, but really that growth really started to soften in Q2 and Q3 to such a point now where we don't necessarily think that the government is going to be able to reaccelerate growth towards the end of the year to get back up to their 5% growth target. So we downgraded the forecast to reflect that. That having been said, the government has been trying to introduce various kinds of stimulus designed to sort of prop growth up. But there hasn't been enough soon enough to really have an impact for this year. So really, a lot of the policies that have been announced, we think, are going to come a little bit too late to hit 5% this year, and they're going to have more of an impact on 2025.
So, when we look at Europe, it seems like there are two different stories here, and the economies are growing on two different tracks. Is that correct?
That is right. I mean, and by two different tracks, I think there's Germany and everyone else, by and large. The growth rates that we're seeing out of major European economies like France, Italy, and Spain have really been trending pretty well recently, especially after the bumpy sort of experience they had in 2023. But Germany's really having a difficult time. We had a contraction in growth in Q2, and we're going to receive Q3 GDP data from Germany this week, I believe, and it's broadly expecting to come in negative as well. So Germany is struggling. There's a couple of different sort of factors behind that. Some of the export markets that they rely on, like China, for instance, for exporting capital equipment, have been having a difficult time. But we're forecasting a mild sort of short recession for Germany over the next 1 to 2 quarters, and then a reacceleration in 2025.
So we're noticing that inflation globally seems to be slowing. I mean, there are some exceptions, like, for example, China, where they're experiencing deflation, in Japan, where they're actually experiencing inflation for the first time in probably about 45 years. But in general, we're seeing inflation slow. Is this going to continue? Is this going to persist?
We're hopeful it will. As you mentioned, it depends on where in the world you look. In Europe, for instance, if you look at the headline inflation numbers, they're already at the ECB's target. The core inflation numbers are still elevated in Europe, but still, there's been a lot of progress. There's been a lot of progress in the U.S., as you know, Dana. We're not at the Fed's 2% target yet, but we believe it's going to sort of manifest itself, hopefully sometime in the middle to early next year. And so the expectation is, yes, that we will continue to see inflation slow globally as well.
Excellent. And so with that, we're seeing interest rate cuts amongst many economies. Do you think that these lower interest rates will be constructive towards the growth rate that we are forecasting for next year?
Sure. So there's a couple of different sort of layers, I think, to this narrative that we have to unpack. Yes, we are seeing global central banks start to cut rates. That really started at the beginning of this year. I think the Swiss central bank was the first to cut in Q1, but it's spread. We've seen cuts out of the ECB, numerous cuts, Canada, Norway, Sweden, and the US, of course. And we're expecting that to continue into 2025 as well. However, all these central banks, or most of them at least, have had their rates very, very elevated into sort of a restrictive stance. This was due to trying to confront the high inflation rates that we just talked about. Now that those inflation rates have come down and are getting towards target in a lot of economies, the need to keep rates elevated and in restrictive territory is moderating. And so the cuts that we're seeing aren't designed to put a rocket fuel into their respective economies. It's just about getting back towards more of a neutral growth a neutral interest rate environment. So in terms of how this unfolds in 2025, we think it'll continue. We don't think that these rates are going to be accommodative in terms of boosting global growth, but certainly there'll be less of a headwind in terms of the growth rates. So as I mentioned just a few minutes ago, our forecast for 2025 at 3.1% is the same as what we are expecting 2024 to round out at as well.
Thanks, Eric. And we're also seeing interest rates fall amongst a number of emerging markets. Actually, emerging markets raise interest rates before advanced economies, and they started cutting first. And so, as you said, I think all of this it's not about easing, it's about reducing the level of restrictiveness. And it certainly, as you said, will provide less of a headwind to growth next year. So this is all really exciting for the global economy. And so we're just going to wrap up here. Thank you, Erik, for being with us today and interviewing me in the first half.
Great to be here.
And I just want to thank all of you for listening to C-Suite Perspectives. I'm Dana Peterson, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.